Hello and welcome back to the channel. In this video, I'm going to be talking about SCHD and why it's a great choice for 2025. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos I post on this channel. And feel free to comment down below if you are adding SCHD to your portfolio. So without further ado, let's get into today's video. In the ever-changing landscape of investing, finding a reliable and strong-performing dividend ETF is a priority for many long-term investors. One fund that continues to stand out year after year is the Schwab U.S. Dividend Equity ETF, or SCHD. As we move into 2025, SCHD remains one of the best choices for investors looking for a combination of dividend income, growth potential, and stability. Here's why SCHD should be on every investor's radar this year. One of the biggest strengths of SCHD is its strong dividend yield and consistent dividend growth. The fund invests in high-quality dividend-paying stocks, focusing on companies with strong financial health and a history of increasing dividends. In 2024, SCHD maintained its position as a top dividend ETF with its impressive yield of around 3.5 to 4%. Its 5-year dividend growth rate exceeds 10%, meaning that investors not only receive steady income, but they also benefit from increasing payouts over time. This makes SCHD an excellent choice for passive income seekers and retirees looking for growing their cash flow. While SCHD is primarily known for its dividends, it also offers solid total returns. The ETF focuses on companies with strong cash flows, high return on equity, and sustainable payout ratios. Over the past decade, SCHD has delivered competitive performance, outpacing many actively managed funds and even some growth ETFs during market downturns. As we enter 2025 with market uncertainty still looming, SCHD's strategy of investing in high-quality dividend-paying companies provides a balance of stability and long-term growth. It may not skyrocket like high-risk growth stocks, but its performance makes it a reliable investment for long-term wealth building. With interest rates remaining elevated and concerns about potential economic slowdowns, investors are looking for ways to protect their portfolios while still generating returns. SCHD is an excellent defensive play because it invests in financially strong companies that can weather economic downturns. During past market corrections, SCHD has shown resilience compared to broad market ETFs. While growth stocks can experience extreme volatility, SCHD's focus on companies with strong earnings and dividend payouts helps soften the impact of market declines. This makes it a great choice for investors who want to stay invested without taking excessive risks. One of the standout features of SCHD is its ultra-low expense ratio of just 0.06%. Compared to other dividend ETFs and actively managed funds, this is an incredibly low fee, ensuring that more of your returns stay in your pocket. High fees can eat into long-term gains, especially for dividend investors relying on compounded returns. SCHD's low-cost structure makes it one of the most cost-efficient ways to invest in high-quality dividend stocks without the burden of high management fees. With interest rates still relatively high, investors are reevaluating their fixed income allocations. While bonds offer stability, their returns often struggle to keep up with inflation. SCHD, on the other hand, provides a compelling alternative by offering competitive yield, dividend growth, and stock appreciation potential. For income-focused investors, SCHD is a great way to generate passive income that can keep up with inflation, making it an attractive choice over fixed traditional income assets. Investors seeking a balance of income stability and capital appreciation often turn to dividend-focused ETFs, and SCHD continues to be one of the most compelling choices. While many dividend funds exist, SCHD's unique methodology, sector allocations, and risk-adjusted performance set it apart. As we look ahead into 2025, deeper analysis reveals why SCHD remains an essential component of a well-rounded portfolio. Unlike many dividend ETFs that focus solely on yield, SCHD employs a rules-based approach to select high-quality dividend-paying companies. The fund tracks the Dow Jones U.S. Dividend 100 Index, which applies strict selection criteria. Number 1 is sustainability of dividends. Companies must have at least 10 years of consecutive dividend payments to ensure reliability. The second is fundamental strength. Companies are evaluated based on their free cash flow, return on equity or ROE, and dividend yield to filter out high-risk payers. The third thing is payout ratio discipline. The fund avoids companies with unsustainable payout ratios, ensuring that dividends are backed by strong earnings rather than excessive debt. This approach prevents SCHD from simply chasing high-yield stocks, which sometimes can lead to risky investments in struggling companies. Instead, it prioritizes financially sound businesses that have the ability to grow and maintain their dividends, making it more defensive and stable of a choice. SCHD's sector composition is a crucial factor in its performance and risk profile. Unlike some dividend ETFs that are overweight utilities and real estate, SCHD maintains a well-balanced allocation with significant exposure to financials, industrials, healthcare, and technology. Here's why this sector mix is particularly important in 2025. Financials, which are typically 15 to 20% allocation, benefit from higher interest rates, making SCHD resilient in a world where borrowing costs remain elevated. Healthcare and consumer staples provide defensive characteristics that can withstand economic uncertainty. And industrials and technology exposure ensures that SCHD benefits from economic growth and innovation while maintaining dividend reliability. This sector balance provides both stability and growth potential, ensuring that SCHD doesn't become too reliant on one part of the market. Many investors assume that dividend ETFs are automatically low risk, but some can be heavily concentrated in high-yield, slow-growth companies. SCHD mitigates this risk in several ways. The first is equal weighted approach among top holdings. SCHD doesn't let single stocks dominate the portfolio, reducing the impact of underperformance of any one company. It excludes REITs. Real estate investment trusts often offer higher yields, but can be more volatile due to interest rate sensitivity. SCHD avoids this risk, making it less exposed to rate fluctuations. And the last thing is no over-reliance on any single sector. Unlike some dividend funds that are overweight utilities and energy, SCHD maintains a diversified sector allocation, preventing excessive risk from economic downturns. These factors make SCHD an excellent long-term core holding, providing income with reduced volatility compared to individual stocks or sector-heavy ETFs. While there's many dividend ETFs out there on the market, SCHD distinguishes itself from other competitors like VYM, DGRO, and DGRW in several key ways. The first is its dividend yield. SCHD's dividend yield is between 3.5 to 4% on average, while VYM is at 3%, DGRO is at 2.5%, and DGRW is at 2.2%. The second thing is its dividend growth. SCHD has a 10% dividend growth on average for 5 years. VYM has a 7% dividend growth rate. DGRO has 8% growth rate, and DGRW has 9%. The next thing is the expense ratio, which SCHD has a 0.06% expense ratio. VYM has the exact same expense ratio, but DGRO has a 0.08% expense ratio, and DGRW has a 0.28% expense ratio. The selection criteria, SCHD looks for quality and yield, while VYM only looks for yield. DGRO looks for dividend growth, and DGRW looks for growth and quality. And the last thing is sector balance. SCHD has a strong mix. VYM is more defensive, DGRO is growth focused, and DGRW is tech heavy. So why is 2025 an ideal time to own SCHD? Several economic trends are working in favor of SCHD in 2025. The first is inflationary pressures and interest rates. While inflation is still above pre-pandemic levels, SCHD's financial and industrial holdings benefit from rising prices and continued economic demand. The second is market volatility and recession risks. If markets experience turbulence, SCHD's focus on quality, cash flow rich companies provides stability compared to speculative growth stocks. And the third is aging demographics and income demand. As baby boomers continue to retire, the demand for dividend-focused investments will grow, increasing demand for funds like SCHD. SCHD isn't just a great ETF for 2025, it's a long-term wealth building tool. Its combination of strong dividend growth, quality stock selection, sector diversification, and risk management makes it one of the most well-rounded dividend ETFs available. For investors looking for passive income, defensive stability, and long-term compounding, SCHD remains a top-tier choice heading into 2025 and beyond. SCHD continues to prove why it's one of the best dividend ETFs available. With its consistent dividend growth, strong total returns, market resilience, low expense ratio, and defensive portfolio, it remains a great investment for those looking to build wealth and generate passive income. As we enter into 2025, investors looking for a well-rounded, reliable income-generating ETF should consider adding SCHD to their portfolio. Whether you're an income-focused investor, a retiree, or someone looking for long-term stability, SCHD is one of the smartest choices for the year ahead. I hope you enjoyed today's video. If you did, be sure to hit the like button and don't forget to subscribe in order to stay up to date with the latest videos I post on the channel. Feel free to comment down below if you're adding SCHD to your portfolio and what do you think of the channel's changes so far. I look forward to hearing from you. If you'd like, check out the join button in the description. You can join our membership program and have your name featured at the end of every single video we publish. So thanks for watching, and I will see you in the next one.